has been exactly a week since Merrill Lynch announced dramatic write-downs on its collateralized debt obligations and said it would raise more than $8 billion of new capital. The move helped stabilize the market. It put a floor under the company's shares for sure, and it is really the talk of the town. In his first appearance now since that news came out, the man behind the decision joins me in a CNBC exclusive, Merrill Lynch Chairman and CEO, John Thain. John, nice to have you on the program.
Maria, it's always great to be back at the exchange.
Welcome back. Yeah, that's right. Having run the exchange, you took extraordinary steps in the last week and a half, selling more than $30 billion worth of CDOs for the bargain price of $6.7 billion, 22 cents on the dollar. Why now? You had valued these securities at, 36 cents on the dollar at the last quarterly report, and now you sold them at this price, 22 cents. Why take the hit and do this sale immediately?
Well, Maria, if you look at our business in the second quarter, the work of 60,000 employees generated $7.5 billion of revenues and almost $2 billion of pre-tax income. But all of the efforts of all those people were wiped out by the declines in asset values and the increase in reserves against the monolines that supposedly hedge these assets. These assets that we sold accounted for about 70% of all the losses we've taken over the last 12 months. So when we had the opportunity to sell them, and to sell them in a bulk sale, which obviously has a bulk discount price to it, and to raise the capital at the same time, we took advantage of that opportunity because it's a great risk reduction trade. It puts us in a much better position to manage our business going forward. And with the new capital, we're very well capitalized.
A lot of people are talking about the transaction. They want to hear details of it, the fact that Merrill financed 75% of the transaction. But let me get your comment on something one of the holders of your stock said the other day. He said the sale doesn't close for 60 days. And if you deferred the transaction, you possibly could have avoided the anti-dilution payments, but you did it now, immediately. Was someone pressuring you to do it? The ratings agencies, Treasury? Why now? Well, because you just had the opportunity.
Yeah, there really was no pressure. We chose to do this. This was a transaction we chose to do. The reasons we did it now was, one, that we could. So we had the buyer lined up. We had negotiated a trade. And waiting until January certainly ran the risk to us that these assets continue to deteriorate in value and that they cause further losses between now and January.
A lot of people felt that when you first came in the job, you were going to do this. And then, you said, well, we don't need to raise capital this time. I'm going to get back to that. But let me ask you, where are you now? So with all of the CDOs been sold, how would you characterize the level of level 3 assets or the securities which are comparable to these securities that don't have a market? Are you done?
Well, let me answer it this way. We have, since the beginning of the year, been reducing assets, and particularly those risky and less liquid assets. And when we began the year, we reported an $8.6 billion loss for 2007. We raised $12.8 billion to cover that loss.
Extraordinary.
So we had a $4 billion plus cushion. But since January 1st and June 30, the value of these assets has declined dramatically. So just to give you an idea, the single A ABX is off 70% from January 1 to June 30. So what was true in January isn't necessarily true in June. And we have been shrinking our balance sheet. We have been selling assets. And this is really just a continuation of that process.
So what is left at this point? I mean, who's to say that what you have on the books today is not going to be worth a lot less in September? Is it fair to say there will be more write-downs?
No, it's not necessarily fair to say that. We have dramatically reduced our risk with this trade. As I said, 70% of our losses came from these assets. But we still have risky assets on our balance sheet. We have brought down our subprime exposure to $1 billion. We brought our Alt-A exposure down to $1.5 billion. We cut our leverage loan exposure in half to about $7.5 billion. We brought our commercial mortgage exposure down to about $15 billion, excluding what's in First Republic. So we are much smaller in terms of risky assets, but it's not zero. And so if asset values continue to fall, particularly mortgage assets, we still have some exposure.
Will you need to raise additional capital?
Well, as you saw in our capital raise, we sold $9.8 billion of stock, and we did that overnight. That is the largest non-IPO equity underwriting ever done. So that $9.8 billion is much, much more than the write-off from these assets. The pre-tax write-off on these assets is about $5.7 billion. So we have a big cushion, and that positions us well going forward. But unless you tell me where asset prices are going to go over the next 6 to 12 months, I can't totally answer that question.
So you're not going to say, look, categorically, you're not going to put yourself in that corner again?
Well, no, I'm going to say the same thing I said before. Today, we are well capitalized. Today, our Tier 1 equity to risk-weighted assets, which is the measure most people look at, is about 11%. That's a very comfortable position for us. So if the world stays the way it is, if asset values don't decline, we will definitely not need to raise more capital. So today, where we are, we're well capitalized.
You've got to be very measured and very careful in what you're saying, because investors are hanging on every word that you say, and this is beginning to impact your credibility. That's what I want to turn to right now. A number of people said to me, look, I've heard him on conference calls. I had investor meetings with him, and he said to me, categorically, we are not going to need to raise capital. We are not going to have to go outside and get more capital because of these losses on the mortgage securities. Listen to what one of your shareholders said to us on CNBC earlier today.
My biggest concern is not just that he's saying things that seem somewhat ambiguous or subject to reversal, but this is now going on for 8 or 9 months, and it seems every month we get a different statement.
What changed, and what are your plans to restoring the credibility to answer critics like that?
Well, Maria, what I said at the time, at the end of the year, at the end of the first quarter, at the end of the second quarter, was true at that time. So, as I said, at the end of the year, we had more than enough capital. Asset values continued to decline. We continued to shrink assets, but asset values fell. At the end of the first quarter, we lost $2 billion. We more than replaced that with $2.7 billion of new capital. We've always said that we would raise capital as we needed to replace any losses. And at the end of the second quarter, asset values continued to fall, and so we raised capital through the sale of 2 assets. We chose to sell these CDOs at this time. The capital raised in the common stock market was tied completely to that sale. So if we hadn't sold the CDOs, or if we couldn't have raised the capital, the CDOs wouldn't have gotten sold. So we decided we wanted to sell these CDOs. That's what triggered the need for new capital. If we hadn't sold them, we wouldn't have gone into the stock market.
So is it fair to say that this market is so fluid still that it's very difficult still today, after all of the extraordinary measures that you've taken, and they are extraordinary, having been able to sell that amount of CDOs in the market, having been able to raise the money that you have, not just this most recent recap, but all year, is it fair to say that you still are in a position where you don't know what the securities are going to be valued at, and you don't know what the market's going to look like in 2 months?
Well, unfortunately, no one knows what the market's going to look like in the next 2 months. But today, as we sit here, we are well capitalized. Today, we don't need new capital. We have more than enough capital for our current positions. But if you say to me, the asset-backed market, the mortgage market, is going to go down another 70%, then that's not necessarily true. So statements as to capital are good at the time you make them. You can't then go back and say, well, John said in January he had enough capital. Well, in January we did. That's not necessarily true in the future.